Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money moves that shape our world. And today we're decoding a company that is aiming to fight cancer and revolutionize medicine with some seriously cool science. But is it all green lights or are there red flags under the surface? We're diving into the latest SE filing from Bio Ltd, a company that has been busy behind the scenes, making some big plays in the biopharma space. Get ready because we're about to unpack their financials, their risky business, and their ambitious plans. First up, let's join the company as they were getting ready to introduce themselves to the public. This filing is all about bringing more shares to the market from existing shareholders and those who hold warrants. Tats for shares, Bio is not selling any new shares in this particular offering, so they won't see any direct cash from selling shareholders. This is really about letting early investors and warrant holders cash out or provide liquidity, and get this, if all the warrants were exercised, that could bring in a massive $62 million for the company. Now, right off the bat, they're telling us this is just a draft and it could change, so we're looking at the picture as it stands right now. They've got about 59 million ordinary shares ready to be sold by shareholders, and another 5 million shares that can be bought if warrants are used. It's important to know that Bio is not making any money from these shareholder sales, but they might get cash if those warrants are exercised. They are eager to get these shares out there on the market as soon as they can. They're playing by the rulebook here, trying to register their shares so that everyone can trade them legally. Interestingly, they call themselves a non-accelerated filer and a smaller reporting company and an emerging growth company all at once. This means they are not a big established player yet, and they get to follow some simpler reporting rules, which is pretty common for companies at this stage. So what exactly does Bio do? They all about fighting cancer and developing new treatments using stem cells and exosomes. Think of stem cells as the body's master repair kit and exosomes as tiny messengers that help things heal. They also supply drugs for clinical trials, which is a whole different ball game. They even went through a big business combination back in August 2025, merging with another company called Breeze Holdings Acquisition Corp to become the public entity we see today. As of late September 2025, they had over 70 million ordinary shares out there. And if all the warrants we just talked about get used, that number jumps up to over 75 million shares. Now let's get to the exciting part, the financial cliff notes. This is where we see the real story behind the science and the strategy. Looking at their balance sheet from December 2024, they had about $12 million in cash and cash equivalents. That is their immediate money buffer, which sounds okay, but we need to see how much they owe and how much they were spending. Their total capitalization, or all the money invested in the company, including debt and equity, was around $15 million if you subtract their liabilities. That's what is left for the owners. When we look at just Breeze Holdings before the merger, they had very little cash outside of a whopping $10 million held in trust. That trust account is for shareholders who might want their money back. If a deal doesn't happen, their debts were much higher than their assets, leading to a deficit. And YD Biopharma before the merger, they were also in a tough spot. Their historical numbers show very little cash and a big accumulated deficit, meaning they've spent more than they've made. But after putting it all together under the new YD Bio structure, things look different. They report over $12 million in cash post-merger, and their total assets are near $16 million. Their total liabilities are around $4 million, leaving them with a little over $11 million in total shareholders' equity. This is the combined picture after the big merger. Now onto the income statement for the combined company. YD Biopharma reported about $510,000 in revenue for the year. Ended December 2024. This might not sound like much, but remember, this is likely before the full impact of the merger and their new ventures. Their cost of sales was about $355,000, meaning their gross profit was around $155,000. However, their total operating expenses were a whopping $10 million. That is a big gap between what they made and what they spent, leading to a huge operating loss of nearly $10 million. This is a critical point. Many companies in this stage spend heavily on research and development and expanding their operations. And when you add in everything else, their net loss for the year was over $10 million. This is common for biotech companies in their growth phase, investing heavily for future gains, but it highlights the need for more funding. Now let's talk about risks, because there are quite a few. First off, they are heavily relying on licenses from other companies, e.g. Biomed, and 3D Global Biotech. If these license agreements end or have issues, it could cripple their ability to sell their products. This is a major dependency. They spell out the Egg Biomed license agreement and say it makes up a huge chunk of their preliminary equity value. If this agreement goes south, it could really hurt their revenue future and even the survival of the business. They have to pay royalties and fees, which could be a burden even if they aren't making much money yet. The same story goes for the 3D Global Biotech agreement, which is for treatments for eye diseases like dry eye and glaucoma. If they lose this license, they can't commercialize these products. Either and again, they have to make milestone payments and royalties even before they make sales. They also admit that the markets they are targeting for their products might not be as big as they think. This is a classic risk factor. Companies can overestimate demand, and they rely on outside companies to make their products. If these suppliers have problems, YD Bio's production can slow down or stop. This is a big one for any biotech company if their cancer tests or medical products don't work out in testing. They simply can't sell them. This is a huge gamble. Here is a complex one. They have auditor issues that might affect their stock being traded in the US if their auditor can't be properly inspected. And this could cause their stock to be delisted. This means investors could have trouble selling their shares and the stock price could tank. Then there are regulatory hurdles. The FDA decides if medical products are safe and effective. Their cancer screening tests are in a tricky area called laboratory developed tests, or LDT. As the rules around these changed in March 2025, making things a bit clearer that for tests ordered by doctors, the FDA might not need to give approval, but it is still a bit of a grey area, especially if they want to offer tests directly to consumers. And if they want to sell anywhere outside the US, they'll have to deal with different countries' rules, which can be another long and costly process. Let's talk about their eye disease treatments. They've got artificial tears that are already approved as over. The counter products, which is a good start, but their exosome eye drops and injections are still in development with big clinical trials planned for many years out, and no exosome drugs have been approved by the FDA globally yet, so that is a very high risk area. They also have contact lenses that have received FDA approval and are already marketed, which is a positive sign for their eye care segment. Looking at their timeline for cancer tests, it shows they are currently marketing them as LDTS, which are regulated by clear standards for lab quality, but they are aiming for FDA authorization for broader access, and this is a multi-year process with many steps. So don't expect these new advanced cancer tests to be widely available overnight. They have an independent lab in the US for pancreatic cancer testing, which is CLIA certified and CAP accredited. These are important quality stamps, but getting FDA approval is still a big question mark, and they want to pursue that for a version of their test not strictly defined as an LDT, which means a more rigorous approval process. Their drug supply business is more established. They've been supplying clinical drugs to big names like Novartis and Alken. Since 2015, these are important contracts that bring in steady, if not massive, revenue for them. The Novartis agreement is good until the end of 2028 and Alken until the end of 2026, showing S. Table relationships. When it comes to intellectual property patents and technology, they are primarily licensing it from EG Biomed, and 3D Global they don't. T own many patents themselves, which concentrates risk on these licensing agreements, especially since Dr. Shen, the CEO, has ownership stakes in both EG Biomed and 3D Global, creating related party transactions that need to be carefully overseen. Their top two customers, Alken and Novartis, were responsible for over 50% of their revenue in 2024. That is a huge concentration of revenue from just two clients. Losing even one of them could significantly impact their financial health. The cancer detection market is very crowded with big players like Guardant Health, and Exact Sciences also developing similar tests YD. Bio believes their technology is superior, but competition is fierce. The leadership team has limited experience running a public company, which is a risk factor. They are also relying on a majority independent board, which is good corporate governance practice. Looking at who owns the company, Dr. Ethan Shen is a major player owning over 54 million shares. Personally and through a holding company Plus, he has a significant stake in Egg Biome. It's clear he has a massive interest in the company's success. As we hinted at earlier, Dr. Shen is involved with both 3D Global and EG Biomed. The companies they license technology from this creates related party transactions, where the company is doing business with entities partially owned by its own CEO. This is not inherently bad, but it requires a lot of transparency and careful oversight from the board and independent committees to ensure everything is fair. Now for the financial statements themselves, YD Bio Ltd as a new entity shows virtually no assets or liabilities, other than some money owed to a related party. It's basically an empty shell before the merger YD Biopharma. Those shows actual operations with revenues and costs, but also a net loss of over $1.4 million in 2024. Breeze Holdings before the merger has a lot of cash in a trust account, but also significant liabilities and a huge accumulated deficit. This is typical for a SPAC that hasn't merged yet. So what is the story here? YD Bio is in the high stakes world of biopharma, with a focus on cancer detection and regenerative medicine. They've got some promising technology through licensing deals and a strong leader in Dr. Shen, the merger with Breeze, gives them access to public markets, which hopefully brings the capital they need for their ambitious research and development plans. The fact that they are an emerging company means they have runway for growth, but also significant risks. They are heavily reliant on their licensing partners, and the success of products that are still in development or early stages. The regulatory landscape is complex, especially with the evolving rules around LDT. And the involvement of related parties needs careful attention to ensure fair dealings. The financials clearly show they are burning cash as expected during this growth phase, and their success hinges on getting these products to market and generating substantial revenue. The reliance on just a couple of major customers also presents a risk if they can successfully navigate the regulator. Your hurdles secure more funding and bring their innovative products to market. YD Bio could be a major player, but the path forward is definitely not without its challenges, and risks are high for investors. What do you think about why? DBio's ambitious plans and the risks involved. Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe to Corporate Decoder for more deep dives into the financial world. Your support helps us keep decoding these complex stories. And hey, if you want to connect with other corporate finance enthusiasts, join our Discord community linked in the description below. Thanks for watching. See you next time.